Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, November 19th, 2024. Hope everyone's having a wonderful day. So we'll start as always with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are twofold. Number one, how much will asset markets cool off as geopolitical conflict heats up? And number two, where does the U.S. I got to change that. Where is the U.S. housing market heading from here? So our answers are: markets are appropriately skittish with the traditional defensives leading today after Russian President Vladimir Putin approved an updated nuclear doctrine that expands upon Russia's list of reasons for the use of atomic bombs. The relatively contained move suggests mild hedging activity rather than large-scale degrossing. That is supportive of our view that a loud, impactful minority of investors are currently capitulating into the year-end performance chase that we called for near the lows of August when the bear porn community was busy stealing money from the retirement accounts of gullible retail investors via subscriptions to their self-serving research products. Elsewhere, the NAHB Housing Market Index builder permits and housing starts data were released. The data indicate improving sentiment but deteriorating activity. No doubt the deterioration activity was triggered by the near 70 basis point backup in the 30-year fixed rate mortgage since its cyclical trough on September 17th. Our industry-leading deep dive empirical study of U.S. business cycle dynamics highlights each of these indicators as a persistent leading indicator of the business cycle, which means their cycles lead the broader business cycle on the way down and on the way up. Homebuilder sentiment has historically been the most leading of the three, so perhaps the nascent uptrend there is indicative of a durable recovery ahead in the U.S. housing market. Transition to our 42 macro dashboard here. As always, we'll wrap up with a question from our community. This one's regarding Trump fiscal policy. It says, Biden fiscal policy has contributed to holding up U.S. liquidity, economy, and markets to counter the Fed's tightening at the expense of the American taxpayer. It is too early to tell how Trump's plan, and specifically Doge, tax cuts, etc., will impact the effects of fiscal policy on liquidity and markets during Trump's term. Do you have a gut opinion? It's a loaded question, but curious. Thanks. So yeah, it's certainly a loaded question. I think it's a very important question markets are trying to digest right now, which is the sequence and scope of the Trump, 2.0 administration agenda. And just based on, sort of reading the tea leaves and what we think we know about the current appointees, the people who are on the short list to be appointed to the remaining cabinet positions, stated policy priorities on the campaign trail, et cetera. It's our belief that, the sort of order of operations probably won't be great from the perspective of an investor. Recall, if you go back to the last time when Trump was elected, we got the tax cuts first in 2017, followed by the trade war in 2018 and 2019. So we got the good stuff first and followed by the bad stuff. My gut feel, which, nobody listening to me talk, none of our clients are using to make changes in their portfolio. My gut feel is that we'll probably get, the bad stuff first on balance. If in our opinion, we think tighter immigration policy and perhaps tighter tariff policy are probably going to be some version of day one policy priorities for the Trump administration. That's where they have the most control from an executive branch perspective. Then you follow that up by Trump will probably use his political influence and whatever influence, whatever sort of de jure influence they may have from the executive branch on curtailing spending from unspent funds related to the CHIPS Act, related to the Inflation Reduction Act. These are two of Biden's big policy wins early in this administration that have contributed to elevated rates of inflation. There may be some unspent funds from the infrastructure bill that they passed in early 2021 as well that they could potentially put the kibosh on and create a reserve of surplus funds that could then be used to offset some of the tax cuts that we're likely to see. So that's probably number three. Number four, you're probably going to get President Trump to the negotiating table with guys like Vladimir Putin, Volodymyr Zelensky, what's my man, Benjamin Netanyahu in Israel, the Supreme Ayatollah in Iran. Maybe they won't go to the negotiating table, but number four on that list is probably trying to broker geopolitical deals. This is something that that became popular on the campaign trail as well in terms of triggering the negativity bias, if you will, amongst the American voters to be fearful of the deterioration in the geopolitical world landscape that has very much occurred under the Biden administration. And then finally, just based on the time it's going to likely to take, to create the federal the budget policy proposals, and then the reconciliation process that's going to be needed to push through the extension of the Trump tax cuts and any other fiscal support subsidies on income and tax cuts that Trump is bandied about on the campaign trail, not the least of which is the 15% corporate tax rate. All that stuff's probably going to come later or last in this order. So in our opinion, just based on what reading the tea leaves, like we could have a pretty negative, sort of series of catalysts from a fiscal policy perspective to start, 2025, with it kind of, building up from most negative to least negative, and ultimately getting positive at the margins, as we get into the second half of the year, once we get a little bit more clarity on the timing and scope of the tax cuts. So this is probably not going to be great for asset markets in 2025, as I talked about in our around the recent around the horn presentations. We are skating on thin ice as investors, from a not only from a positioning cycle standpoint, but just from a broader liquidity cycle standpoint. The deterioration in liquidity over the last several weeks has been observed in market, and it's certainly causing us to have a more dour impact, more dour outlook rather, for asset markets relative to our starting point prior to the election. And so we're seeing some changes on the margins that are moving in a negative manner, that are starting to peel back the onion on some of our previously existing bullish fundamental beliefs. So we need to pay attention to some of these moving parts and dynamics. And most importantly, clients need to pay attention to any pivots that KISS or Dr. Mo signal in the coming days or weeks. We could potentially be pulling forward some of the negativity that we just discussed in this macro minute. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, November 19th, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.